Money Monday is starting soon. 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 As soon as it finishes prepping for Facebook. There it goes. All right. Gonna share this. Yeah, all right. Gonna share this on my Facebook page. Share now.
And here.
All right. Cool. Let me get back out in front of the camera. Let me get back out in front of the camera. Let me get back out in front of the camera. Money Money is starting soon. It's starting right now. Hi, everybody. Thank you so much for joining us once again. My name is Henry. I am your friend in finance, and we're joined today by Christopher Tanner.
Hello, everyone. Hi, Henry.
Hi, we got a wonderful Money Monday planned for you today. All about this exciting concept right here, compound growth, which is as we're going to go over it today. It could be an investor's best friend, it could be your best friend, or if you're not thinking about it correctly, it could be you don't even know, but it could be your worst enemy. So we're going to be learning all about that today. In the meantime, don't forget, if you have any questions, feel free to comment. I have my window opened up right where I could see it right past my phone, so I'm going to be able to read any comments you post, and we'll be keeping up with questions, and we'll be answering them as we go. But before we begin, also one more thing. Our book club met for the first time last week. It was a rousing success.
Woo!
And we have our next meeting. This is for clients out there. We have our next meeting, not this Wednesday, but next Wednesday. So after next Wednesday, that's gonna be a clean cutoff. We're not gonna allow any more people to register for this round of this book. But if you're interested in joining us for the book club, please join us. It's a great book. We got a lot out of our last meeting. And as we've heard from a lot of people, it's just really great to be surrounded by people who want to learn, and that way we can all support each other as we're all learning about the same topic, about finance, and about how we can make all our finances work better together. It's just a good group of people. I mean, I'm a big fan of our clients, so that's a good thing to have.
And Henry, I'll just add in here for those of you that aren't clients, or if you're a client and just can't make it to this cycle, we'll shout out this book one last time. The book that we're covering is called Why Smart People Do Stupid Things with Money. It's by Bert Whitehead. He's the person who trained our boss, Bob Schumann. And so even if you can't make it to the book club, this is a great read for anybody out there. It really helps you kind of think about finances in a holistic way, and for me in a completely new way when I first read it.
Yeah, me too. And one more, and to jump on that too, is that if you're a client and you couldn't make it this time for this book club, don't worry, we're going to have other book clubs in the future because everybody's having a good time. So we want to make this a recurring thing. But if you can't make it, but you're interested, just let us know. That way we can make sure to keep you on our list. So that way we know to reach out to you specifically when the time for the next one comes. But without further ado, compound growth. Compound growth. This is a really, for me, it's a really fascinating topic because it's I enjoy math, but more specifically too, I also enjoy things like algebra and visualizations with graphs. So Chris, I think one of the best ways that we can describe this for people, what is compound growth, is comparing it to something like linear growth. What do you say we start with linear growth? How about that?
That's great. Yeah.
So linear growth, everybody's familiar with this. We learned this when we're just growing up. When we're learning math for the first time. What is 1 + 1? 2. What is 1 + 1 + 1? 3. And linear growth is pretty simple. It actually just, if you're looking at it on a graph, it just looks like a straight line. Look at that. It's a straight line. You know exactly where it's going. It's the first math that we're exposed to as children. What makes this, and you can see why it's called linear growth, it creates a line. So they named it pretty appropriately, linear growth. We also use this a lot of times when we're thinking about, oh, how much do we have in our bank account? Well, I had $100, but then I made $100 more while I was working, so now I have $200. So that's how linear growth works. Compared to that, compound growth doesn't make a straight line like that. It makes a curved line like that. So compound growth, I think it's geometric is what it is, as opposed to thinking, 1 plus 1, or let's do this with algebra because that's fun for me. X plus X, we're thinking in terms of X. The time symbol is gonna, I was gonna make it times, and it was gonna look like just 3x. So X times X, and that's one of the really big differences that we're gonna see with compound growth. And it's honestly, it surprises people. People don't realize how powerful this little symbol is, and how much different the result can be than if we're just looking at the plus sign. We've talked with a lot of people, and I think we've even mentioned in meetings talking about how people have a hard time seeing and predicting compound growth in general. So I guess one of the best ways to kind of show an example of this is, I guess, probably an example of what is an example of compound growth. Chris, what would you say would be a good example of compound growth?
So I'll go ahead with the definition, just because you've got the visual. I'll give a verbal, and then Henry, I love the example you told me just before this call. So I'll turn it back over to you for that. But as far as defining what compound growth is, it's essentially the concept that when you earn interest in an account, so say you have $1 and then you get 10% on it, then you have $1.10. The next time you earn interest on it, you don't just get 10 cents, you get 10% of the new total that's in there. And so you actually get 11 cents in that case, because you now have $1.10 that's growing. And so that's where that multiplication, the exponential effect comes in, is that all the growth you've already gotten is also earning growth. You're getting interest on interest over time.
Yeah. I was gonna say, I think, one of the, you mentioned interest. There's like a couple of, it came to mind just now. There's a couple other words that people use that can mean compound growth when we're talking about investing. So we have interest, like in bank accounts, and that's one that we're all pretty familiar with. If you're getting 10% interest in your bank account right now, I'm incredibly jealous because
you're probably not. Is the answer.
Some other ways people might hear it is a return or return on investment. You might hear that. You might even hear just gains. And especially when investing, Chris, you highlighted this. When investing, you're usually going to hear it in terms of a percentage there. A percent that you're getting on top of whatever your initial or principal amount was. But there's a couple different words that you can look out for, and whenever you see those, you can go, oh, hey, that's compound growth that we're talking about there. So it's time to start thinking about this in a slightly different way. How does that sound, Chris?
That sounds great. Thank you for just highlighting those vocab words. And go ahead and share that example. The ancient Greece. It's so good.
Yeah, and then I want them to hear the one that you sent me, because that's a pretty cool one. This one came to mind a while ago because there was a meme that was going around the internet that was talking about how if you lived, and this is just the meme's purpose was to understand how much money $1 billion was. And it came out to, if you lived in ancient Egypt 6,000 years ago, and you worked 40 hours a week, every week for 6,000 years, so that would end up being 6,000 years times 52 weeks times 40 hours a week. And let's say you made like $30 an hour, times $30 an hour. So this is, we're seeing some multiplication here, but this is actually linear growth from day to day, hour to hour, $30 more every hour, $30 more every hour, $30 more every hour. We're just doing that a lot of times. How much money do you think you have at the end if you just put those in like a checking? How much money do you think that ends up adding up to at the end of 6,000 years of just $30 and you don't spend anything and you're just saving it? One more hour, $30. It comes out to, and this is going to be a little bit rough because I did this math earlier, but I don't remember the exact number, but it came out to something like a little bit over $340 million, which is still a lot of money, but it's not even halfway to being a $1 billion. See, I think I did the numbers again with like $50 an hour, and it came out to $600-some million. Still not at $1 billion.
So at linear growth over that time, you wouldn't even earn $1 billion from working full time for 6,000 years.
Yeah. So, and again, let's just visualize this. $30 an hour every hour for 6,000 years. Let's say $1 billion is up here. 1 billion. The line over time, you're basically just going like that. And that's my attempt at a straight line. It's linear growth over that entire period of time. But then I remember I saw that meme, and I knew about compound growth, and so I wanted to see, okay, well, what would have happened if, just for context, if you're investing in stocks or something, you want to aim for what is it, like 8% real return over time, Chris?
That's historically what over long periods of time what the stock market has returned. Yeah.
Yeah. So, and I didn't want to assume, that's over a long period of time, but I didn't want to assume something so good. So I even when I plugged this into my calculator, I assumed, what if we got we put in at the beginning of those 6,000 years, we put in $1. We put in a single dollar, and we invested that in something that was super safe, but only got 1% return, 1% interest. And again, compared to stocks, like that's 1/8 of what you can expect from stocks. I think bonds, which are super safe, they usually get, we're in a weird time right now, but they usually get a higher return than 1% historically. But I thought, no, let's just 1%. Let's see what ends up happening. And you've got what ends up happening is, because this is again linear growth, so it's times 1%, 6,000 times, raised to the 6,000th power. The number that you get you can do this calculation on your phone right now. It's 1 times 1.01. That's 1%. That's the 1% gain over the course of a year. And then raise that, look for the little caret symbol to 6,000 years. Again, this is 1% over an entire year, over 6,000 years. What you end up getting is something like 84 octillion dollars. To put it in a little context, that's a lot of zeros. Let's see, octillion. This is septillion. This is sextillion, quintillion, quadrillion, trillion, billion is back here. I think, yeah, and the numbers just keep going. I think
6 more zeros.
Yeah, I'm running out of room here. There's so many zeros that on some of my depending on your calculator, you might not even have room on your calculator. There's a lot of zeros back there. And the reason for that is because compound growth, we usually see that working like this. Instead of that straight line, this is going to be 1 billion again. Boop, 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 boop. It usually at the beginning you see it, and depending on how much it is, it barely seems to move, and then all of a sudden it just shoots up. That's so that's what compound growth looks like over a really long time, and that's one of the reasons why it can be an investor's best friend, because you can start out with very little money, and so long as you're getting solid returns at first, it'll look like it's not really moving, but then at a certain point, it'll hit a critical mass, and then boom, it just skyrockets. And that's pretty exciting to me. I don't know about you, Chris.
It really is. I love that example. I'd prefer to have earned that $1, put it aside, and let it grow for 6,000 years than working full time for 6,000 years.
Absolutely. Yeah. And this is what Bob talks about making sure that it's not just you working for your money, it's your money working for you too. And this is the way that your money ends up working for you. But before we go into, I was about to go into, but it's really hard for people to understand and predict. I also wanted, Chris, if you want to share your Bobby Bonilla Day story from the podcast you sent us.
Yeah, absolutely. So we'll put a link to this show in the event that Henry shared. But if you're a sports fan at all, you may be familiar with Bobby Bonilla Day, or especially if you're a New York Mets fan. Every July 1st, Mets fans actually are in mourning because of this deal that the New York Mets made with a former really good player of theirs, Bobby Bonilla. And he retired a little over 10 years ago. It was around 2010. And the team still owed him about $6 million. And he signed an agreement with the team to, instead of getting paid $6 million when he retired, that instead they would wait 10 years to pay him anything. And then starting 10 years after his retirement, he would get $1.2 million a year for 25 years. So, which adds up to over $30 million over that time period. And the New York Mets write this check to Bobby Bonilla on July 1st every year. And so, again, for any sports fans out in the audience, you may have heard of Bonilla Day, and so many Mets fans know that this is taking place on Bonilla Day, and they're just unhappy that, oh, this is such a bad deal. How could the Mets have messed this up? In addition to all kinds of other bad fortune they've had over the past couple decades, they see this as a terribly bad deal, a terrible failure, that instead of paying $6 million once, they're paying over $30 million over the next still 20 some years. I think 2035 is when the last payment is going to happen. But what they don't know is that economists say this wasn't a bad deal for the New York Mets. Part of the agreement was a calculation that this $6 million that they could have paid Bonilla up front would be able to grow with compound growth, and provided it got an 8% return, the Mets would actually end up ahead after these 10 years of growth plus 25 years of payment of $1.2 million than if they had paid Bobby Bonilla just the $6 million up front. So it's a reframe, and to Henry's point about it being hard to envision, hard to calculate, the 6 million 10 years ago seems like a small price to pay to avoid 25 years of $1 million+ payments. But as it turns out in the math, those are pretty equivalent.
Yeah, and that's pretty awesome. I am because I'll be honest, when I first started listening to the podcast, I was actually like my initial thought. I know about compound growth, but my initial thought was, oh, I can't believe that they're paying $30 million over the course of. And I even had the pre-frame that you told me it's about compound growth, but just wasn't thinking, and my mind went $30 million for $6 million. That doesn't seem like a good rate. Seems like they got the worst deal. Bobby Bonilla really went out there. So even somebody like me who lives this like every day, even I can have trouble seeing this compound growth. I'm Chris, do you have any like theories about why people have such a hard time seeing compound growth like this?
I think it has to do with just not fully visualizing or understanding time value of money. That's just a term we use, which in short means that $1 today is worth more than $1 tomorrow, and it's worth a lot more than $1 far in the future. But we just don't make that calculation in our minds. We don't discount that future dollar, because $1 today is worth a lot more than $1 10 years from now, because of what you can do with $1 today. Just like the dollar 6,000 years ago could be worth 84 octillion today. It's just that discounting of future value is hard for us to do. It's not natural.
Yeah, my one of my thoughts is that if we're going back into hunter-gatherer times and we're trying to find food and find prey, that when we're running after something, we just kind of because we're trying to predict where it's going to go, and the food is going in that direction. We don't assume that it's going to, for some reason, have a curve, and when it's running away from us, we assume that it's going to keep going in a straight line. So we try to predict where it's going to go based off of that straight line, because there's probably a thing where if it can go this way, then it can go the other way too. And at that point, that's too many things for our brains to understand. So
Yeah.
I do think it's something our brains have a hard time seeing it, but then that's why we, especially here at Plan and Act, that's why we create different algorithms and different models to really visualize what is this actually going to look like in the future. One of the models we use is actually pretty well known amongst financial people. It's the Rule of 72. Chris, would you mind explaining what the Rule of 72 is?
Yeah, absolutely. So Henry shared earlier that we'll often use the word interest rate or return on investment. So let's use the word interest rate. That's what you might see on a bond or in your savings account. So the Rule of 72 says that divide 72 by whatever interest rate it is you're getting on your money. And so let's use 7 in the example, because that'll be kind of easy. Let's say you're getting a 7% interest rate. And the result of that division will be how many years it'll take for the investment to double.
Years to double.
So in this example where the interest rate is about 7%, you're just dividing 72 by 7. It'll be about 10 years for an investment getting 7% for it to double. Whatever the starting point, it doesn't matter. If it's $1, if it's $500,000, if it's increasing at a 7% interest rate, divide 72 by 7, and you get the time to double.
Yeah, absolutely, and that's pretty exciting. I mean, knowing that you can get a 7% interest, and then you're going to have 2 of that money in 10 years. That's pretty awesome. Here's a challenge for you listening to us. Go where a lot of people probably have or have money in their checking accounts, savings accounts, which get really low interest, and you might even notice when you look it up, you'll not see a 7%. You might see a 0.01% interest. that's not a typo. That's actually how much interest you're getting. Try dividing 72 by 0.01 interest and find out how long it's going to take you to double that money.
I just did it.
It's going to 70.
It's going to double in 7,200 years.
So this is one of the reasons why, which is I don't really plan on sticking around that long to see that happen, and it's one of the reasons why one of the things we help clients with is, where is your money going to be the most effective? Because some of it should stay in checking and savings, because you're going to need money for things like car breaking down, house repairs, furniture breaking, things like that. But if it doesn't need to be there, look at how long it's going to take for that money to actually end up doing something for you. So that's a really low, we have really low interest rates right now, and that's why we help people diversify into things like bonds and real estate and things like that. Chris, we actually aim for what, because we want to double every 5 years. That with our target with platinum clients and up, we want to double every 5 years, which is 15% net worth growth. Is that correct?
That's right. So when we're setting goals with our clients, we encourage them to set a goal for how quickly they want their net worth to grow. And like Henry said, our starting point is whatever growth rate will cause their wealth to grow, to double in 5 years. And so using the rule of 72, that growth rate needs to be about 15%. So because 72 divided by 15 is close to 5. And that's not just from investment returns, that's from looking at their net worth altogether. So looking at where are they reducing bad debt? What are their investment returns? What is their savings rate? All these things that either all these things that add to your net worth in different ways. So 15% is usually that target.
Yeah, and that's a huge difference between that's a huge difference between the 0.01% interest getting 7,200 years. If you notice, that's I went with when I was doing my math for the meme earlier, I went with a 1% interest, which is already a really low rate of return. It's like 1/15 of what we aim for. 1% interest is, but interest rates right now in banks are just so low that, you know, one of the things that Bob keeps saying, which is true, is right now cash is trash. You got to be able to put money in more effective places, and that's one of the ways that we really add value to people, is helping them understand how to get this return as opposed to this return. This one, we don't like that one.
Yeah. So Henry, you talked earlier about how compound growth can sometimes work against you. We've given a lot of great examples about where it's great and how it can help you grow your wealth, grow your investments, grow your net worth. So what were you referring to with the negative side? Negative side,
yeah, absolutely. Well, this one, if you think about, for instance, credit cards, something when you owe interest on something else, instead of them company paying you that interest, you're paying that money to somebody else. And from their perspective, for instance, like if we take credit cards, again, we aim for 15% growth at Planet Act. Credit card companies, you probably, if you actually, a lot of people don't actually end up looking at how much interest their credit cards are charging them. Credit card companies are really good at hiding these numbers in the APR on their statements, but it's usually 20% or more. 20% or more. 20% is usually around the lower end of what a credit card company will charge. That's interest. Instead of them paying you, that's interest you're paying the credit card company. So from their point of view, they're getting a 20% interest on their investment. So how soon is their money going to double if you just keep doing like the minimum payments and all that, and you're just barely, you know, maybe even you miss a couple payments, and then that interest really starts to add up. with 20%, if the credit card companies are getting 20% interest off of you, let's use our rule of 72. 72 divided by 20% equals, and three, it's basically
About
three.
3.5, 3.6.
Yeah, 3.6 you said?
Yeah.
Yeah. Oh yeah. There we go. Yeah. Thank you, Chris, for the math. So their investment. Let's say you go out and you buy something for. Let's say you splurge on a really nice day and you spend $1,000. $1,000. That already hurts, but you're like, oh, I got a credit card. Let's never mind the interest. I'm going to just put it on the credit card and then pay minimum balance. By the end of 3.5 years, 3.6 years, they will have gotten double back of what you actually paid into it. So this is one of those ways that compound growth works against you because you're doing the paying, the credit card company is doing the growthing. So watch out for situations like this, high interest rates, where you're going to end up having to double the amount you're actually paying in a very short amount of time. Because there are situations like this that can end up hurting you and can be a huge drag on how much your net worth is going to actually grow over time. One of the examples you brought up, Chris, was actually inflation as well. You want to talk about that?
Yeah. So we talked about inflation just in a recent Money Monday, and if prices of things are going up, things are getting more expensive. Let's just say, a recent rate we saw for the month of May is 5% when you annualize it. Inflation is something that also grows in a compound way. So to then see what effects that would have on how many years it would take for prices to double at a 5% inflation rate, that calculation that Henry just put on the board is how you find that out. So 72 divided by 5, you get about 14, right?
14. Like 14.
Yeah, 14.4.
14.4 years.
So if the inflation rate were to continue at 5% for 14 years, whatever the price level was at the start of that period, it's double that. Your gas is twice that. Your house is twice as expensive. Your groceries are twice as expensive at the end of the 14 years.
Yeah, I'm just thinking about how, when you mentioned gas, I was thinking about how I've heard a lot of people complain about gas prices now and how it's gone up a little bit. But if we really think about the effect that inflation could have, then that's going to really be growing over, at the end of 14 years, we'll end up paying like $6-7 per gallon, depending on what kind of gas you're buying too. So right. Nobody wants that. And that'll be a reason. If you're interested to hear more about inflation, check out our previous video on inflation. Chris had the wonderful idea that we should reference other videos in these videos, and he's a very smart cookie like that. So yeah, is there any other points you'd like to add about compound growth, Chris?
Well, I guess just bringing it home to like practical application. We talked about some of the ways it can be good for you, some of the ways it can work against you if you're not using it for your good. So I mean, a quick takeaway is if you use a credit card, don't let that compound growth kick in. Pay off your credit cards as much as you're able. So that, if you pay it off before the end of the month or by the due date, the compound growth never starts snowballing. So then it'll never hit that inflection point. It'll never double on you if you're just paying off what you paid. And then to combat things like inflation and to actually get the benefit of the snowballing for you of that increase in your net worth and wealth, just get invested early, even if you have a little bit. The best thing you can do for your wealth long term is invest it in something with a long-term time horizon. And one way to do that is dollar cost averaging. So even investing a little bit over time, every so often or on a regular basis, will really kick things into gear down the line.
Absolutely. And if you at some point are feeling a little hesitant about, should I invest or not, think about what we said, the example we brought up earlier about the difference between working every day for 6,000 years, every weekday for 6,000 years, and the difference between that and just putting a single dollar in a really poorly, that investment would have been really inefficient. But even a really inefficient portfolio like that gets 1% return over that long a period of time ended up getting huge amounts of return. We can, with a more efficient portfolio, we can make a lot of stuff happen for you to hit your goals and whatever they might be in their specific time horizons now. So like Chris said, getting started with investing, that's a huge step, and we encourage you to get invested. If you have questions about it, reach out to us. Both Chris and I are here to answer questions. Leave a comment, send us a message on Facebook on our Plan and Act financial planning page. We're here to support you. We're here to help you. Thank you so much for listening to us today.
Henry, can I just close with one quote, sort of a proverb I've heard?
Yeah.
I've heard somebody say that the best time to plant a tree is 20 years ago, if you want to have an adult tree to benefit from the shade or climbing in the branches. The next best time is right now, is today. And the same thing applies to investing. The best time to start investing to get compound growth was 20 years ago. But the very next best time is right now. And yeah, need to work. Yeah.
I really like that. Well, yeah, thanks so much, Chris. I'm going to draw a tree here. It's a little tree.
Nice.
Yeah, awesome. All right, if you're watching this as I end the Facebook live feed, this is you right now. All right, we can plant this tree, get this tree started right now. Chris, thank you so much for that metaphor, because that's really wonderful.
Yeah, absolutely.
Thank you all so much for joining us for another Money Monday. Again, I'm Henry. I'm your friend in finance, and we have Christopher Tanner.
Pleasure to be here,
everybody. Bye.
Bye, everyone. Good night.